Welcome to the first Q&A session in an ongoing NEPC web series entitled 5 Questions With. Our objective is to bring you face-to-face, candid, and refreshing insights from thought leaders across investment consulting, investment management, academia, among others. Our first Q&A session is with NEPC's Chief Investment Officer, Tim McCusker.
Well, it's been great so far. I work with great people on the research team, so managing the team has been easy. I've just let the people on the team run with their ideas and try to find the best possible investment ideas and investment managers to implement those ideas. The thing I'm most excited about in the new role is the client strategy team that we've created, which is 3 really senior partners who have areas of certain expertise where we think we can bridge that gap between research and consulting, where we have someone focusing on defined benefits, defined contribution, and then alternatives, which I think is especially appropriate for endowment and foundation clients, where that's a big focus in that area. We have Sean Gill, one of our senior partners, who has a wealth of knowledge of alternatives, helping clients to strategize on how to implement alternatives programs across hedge funds, private equity, and real estate. I think that team's going to have a big impact on our clients. Well, it's lasted a while. It's one of the longest runs we've ever had, and if we look at the last 30 months, the US equity market is up over 60%. We've really only had a couple sustained periods like that over the last 40 years, the mid-1980s and late 1990s leading into the tech wreck. So that's a bit of a danger sign, wondering how much further this can run. At the same time, Fed policy remains incredibly accommodative, and when we look at other time periods like this, even as rates start to rise, if the Fed embarks on a rate hiking program, equities can continue to grind higher and spreads can stay tight for quite a while, even as that monetary regime changes. Well, we don't see a lot of super compelling opportunistic trades right now, and when we're in that kind of environment, when most markets appear maybe not ridiculously overvalued, but at least fairly valued or above fair value, we think that risk balance is the right starting point, not taking one concentrated bet in any one asset class, particularly equities. So we think risk balance is the place to start, and then tilting into certain areas over time where there are attractive opportunities. Right now we've talked a lot about emerging markets. They've had a better year this year, and we still think that that's a place to overweight where they've had underperformance the last few years, and we see a big secular theme of stronger growth there. Our view on emerging markets has evolved quite a bit over the last few years from a broad beta theme where we look to just get exposure to that asset class, both equities and debt, both hard currency and local currency, to one where we still see a strong secular theme for growth, particularly consumption growth, as that middle class continues to grow and evolve in emerging markets. Where we've evolved in our view is making sure that we have more active management or entirely active management in those emerging market programs, because these different emerging markets are very unique. It's hard to just express a view on emerging markets broadly now. These countries have very different characteristics and will grow and evolve in different ways. Well, certainly we'll be looking at geopolitical risks. There's enough of those now, and the way that they impact markets will be something that we monitor closely. So far, some of the issues that have popped up, whether it's Russia and Ukraine or issues in the Middle East, particularly Iraq, haven't spooked the markets too much. Volatility has remained really low, but we'll still be monitoring those to see if there's something that can knock the markets off of their continued strong run. And then the other thing that we'll be looking at both next year and beyond is both Fed policy and global monetary policy. They've been low and accommodative for an incredibly long period of time. The Fed and the Bank of England have indicated they'll begin to raise rates in the near term or into 2015. How the other economies adapt to that and how those economies adapt to a different rate regime will be interesting for all markets, not just rate markets.
Thank you for joining us today. And Tim, thank you for